We always hear the saying, money can't buy happiness, but we like to give you guys something to ponder. Money is a sixth sense that will make you enjoy the other five. All you need to do is learn how to be at peace with your investment and financial decisions. Hey guys and gals, welcome to another episode of Financial Ventures. We are so glad you're back again here on our channel. And with that being said, today we will help you understand which funds will work best for your financial portfolio. If you like the content, be sure to like the video, subscribe to our channel, and hit the notification bell for more informative financial videos. Remember, all you need is financial venture in your life's adventure. You can only be at peace with something if you truly understand how it can be of advantage to you. In this episode, we will make sure to keep you posted and updated with what will work best for your investments. Is it an index fund, mutual fund, or ETF? Always remember that investing is all the same as driving your car. It could potentially bring you wherever you want to be, but only if you know how to make it start. Before we begin, let us try to go back to the basics of investments. What are stocks, bonds, and investment portfolio? Stocks, as we often hear, are a representation of your partial ownership of a company, which means you are buying a piece of a share from a company. You basically have a claim on its future earnings because you have a fraction of its assets. There are two ways of which you can earn money through stocks. First is the stock appreciation, or the price of the share you own goes up. You either keep it or sell it to other investors. And the second is earning through dividends. If you want to learn more about dividends, don't worry, as we made an infographic about it already and we'll link it down below. Now, what are bonds? Bonds are among the most common investments, yet few people fully understand them. They are basically a loan given to a company or government by an investor. By issuing bonds, the company or government pays interest on the money they've loaned. They usually collect bonds to fund new projects or help with ongoing expenses. People like bonds because it preserves their money while generating additional income along the way that can strengthen their investment portfolio. Right, so what's an investment portfolio? Technically, it is a basket of assets that keeps your bonds, stocks, cash, and other financial securities intact or in one place. Here are certain examples of why you need to understand the importance of having a portfolio. If you invest in some stock and the price goes down, so does your entire portfolio. If you invest in multiple and correlated stocks, they all grow and dip together. This also means that if prices dive down, so does your entire portfolio. In 1952, a Nobel Prize awardee, Harry Markowitz, invented the modern portfolio theory, thanks to his big economist brain. This just simply means that your portfolio should always be diversified and uncorrelated with the explicit aim to minimize the risk of investment portfolio. As an example, half of your portfolio should include gold and the other half will be stocks. So if stock prices went down, only half or a certain percentage of your portfolio will go down, and the gold as the other 50% will still appreciate over time. We hope we made things clear, and now we will take you along with us as we differentiate index funds, mutual funds, and ETFs. Make sure you place your bets before we roll the dice. A mutual fund, simply put, is a collection of investments that compiles together a large sum of investors and their money to purchase different securities like stocks or bonds. When you buy a share in a mutual fund, you get to have small portions of all the investments included in that fund. It is like you go to a grocery to buy a basket of fruits, yet you go home with just a portion of the basket of fruits. Yes, a simplified mutual fund. We do have several pros when you decide to get that mutual fund. First, it helps your portfolio be diversified because you will own a whole wide variety of investment types. Second, financial professionals get it done for you. They get to make all the decisions that will benefit your investments with them. How does it work? As simple as this. Imagine you just recently retired from the workforce, but you wanted to invest in stocks. But you do not like the idea of studying all the types of stocks and bonds. This is where you will decide to purchase the mutual fund. It's like purchasing an entire portfolio of diversified stocks, while in reality, you only own one mutual fund. They got it all covered. If you wanted to be sure which mutual funds work best for you, we highly suggest that you review the fund's prospectus. Okay, so what now is a prospectus? It is the information about the fund, which includes its fees, charges, performance history risks, minimum investment amounts, and others. Basically, the Facebook profile of the mutual fund. Now, once you are decided which one works best for you, you can now purchase it and in return, gets to have shared it already. You now participate in the assets, gains, and losses of the fund. Owning a mutual fund lowers your risk, but the thing is, all mutual funds are actively managed, which means fund managers control the growth and the investment decisions of the fund. They typically make informed decisions based on their financial analysis and professional expertise. Fund managers aim to gather the biggest returns they can for their investors. Some talented ones can earn good returns, but most times, we do not have a guarantee of success. Whether you win or lose, you need to pay your fund manager, which means they have fees that will be paid from the fund assets, which can even lower returns. Unlike stocks, the value of the funds is calculated and updated when the market closes. It does not change throughout the day. Two ways you can earn through mutual funds: dividends and when the funds appreciate in value. So, let's now talk about our index funds. Index funds are funds that track a market index. They use a passive investing strategy, which simply means they want to deliver returns similar to an index of investments in the market. Or in simple words, they are built to have similar performance to a major market index. Index funds have several indices, and to give you an idea, here are some of them. S&P 500 follows 500 largest stocks market. Dow Jones Industrial Average includes 30 large-cap industrial stocks. Nasdaq 100 follows 100 large-cap technology stocks. And Russell 2000 tracks the 2000 small-cap stocks. These are some examples of index funds, which means you can track different assets including stocks and bonds. Oh yeah, index funds can also accumulate through commodities, currencies, and other assets. The risk of investing in an index fund is that you're also exposed to the risk of the index you're following. Let's say if the S&P 500 declines in value, so does your index fund. But the biggest benefit you can get is that it has a lower expense ratio because they are passively managed. They simply track an index, meaning they have lower returns because the buy and sell are infrequent in this fund. But it's still a win-win situation since if you have low expense rations, you have a bigger room for growth and higher returns because you will not pay a fund manager. And for the last part, what is an ETF? Also known as exchange-traded funds, they have introduced 15 years ago as index funds. ETF is basically an index fund except for one major difference. You can buy and sell your shares whenever the stock market is open, unlike in index funds where you can only buy and sell once a day. ETF allows you to trade 24/7, but it does not encourage long-term investing success. You can watch it go up and down the entire day, and it will just push you to be impulsive in buying and selling. Not a good decision, eh? I bet Warren Buffett will not be proud of us gambling just because we have the chance to. To wrap things up, mutual funds are expensive, but do not guarantee success even if they aim for bigger returns. Index funds are diversified investments with lower returns, but with bigger room for improvement. And ETFs are just like index funds, but you get to play around 24/7, which discourages long-term positive outcomes. Again, we are here to give you the best options and inform you of what suits you best. But at the end of the day, you gotta trust yourself to get the money rolling. Feel free to comment down below on what you think is a good fund that you guys would want to invest in, or any financial topics we can shed some light on. We hope to see you at the next one. Remember, it's better with financial ventures in your life's adventure. Take time to realign your priorities and set your goals straight to get that shiny modern house that is on the listing today.